This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. With all the reductions in employees and assets at well-known financial firms, is Retire Smart in trouble? Why has the rate of the rise of the S&P 500 been disproportional to the return for the average investor? And what's David's take on the Buffett indicator, saying the market is currently overvalued? David Brooks has answers to these questions in today's Q&A episode. Into the Q&A we go. First question, David, is about the financial planning field in general. I've seen news articles about reductions in employees and assets at well-known financial firms such as UBS and Edward Jones. Is this an industry-wide slump? Are you struggling at Retire Smart?
Well, I appreciate the question. No, we are not struggling. In fact,
I can't keep track
we're on pace.
Of all the new people.
Yeah, we just hit fastest growing companies in America for the fourth
year in
consecutive year. Less than 400 companies we were told have ever achieved that. So, no, not struggling at all. And in fact, our industry is actually doing well. What you're seeing is a massive transition away from what we used to call the wirehouses. When I started my career at Payne Weber, which UBS bought, by the way, and we're seeing a shift of advisors leaving the big boxes and going to the RIA space, Registered Investment Advisor. Because when you work as a Registered Investment Advisor, we're working under the Investment Advisory Act of 1940, which means we charge for advice, not transactions. Where when you are securities licensed, like I used to be with Series 7, 9, 10, 24, all these licenses, you got compensated by the transaction itself. When I started, if you bought a stock from me, and Disney was the popular stock because I was in downtown Orlando, right? You want to buy 100 shares of Disney, the minimum commission I could charge was about $375 at Payne Weber, right? Back in the 90s. And this is before the advent of online trading like it is available today. And so the advice was complimentary, the transactions what you paid for. Well, most people prefer just the opposite. I'll pay you for the advice, and the transactions are generally complimentary now. So, but yeah, you're seeing an exodus from these big firms. And the reason for that, Chip, is there's great people there. I have friends, just to put this out there. There's good firms, and there's great people at them. But they're handcuffed a bit. They can only offer what is on the product distribution approved list of that mothership, right? Like there's an approved list of mutual funds or investments they can offer for their clients, and they're beholden to only saying what the firm allows them to say. So go to one of those type of firms, and you're probably not going to get proactive tax planning because I don't think the firm will allow them to do it. So there's a myriad of reasons for this, and we're just seeing a transition in industry to companies like ours. But thank you for asking. No, we're not struggling at all. In fact, we continue to grow, our 8th consecutive record year since starting.
Next question, David, is about investor market return. I saw a news story about a study by J.P. Morgan Chase. It said that from 2002 to 2021, the S&P 500 went up 9.5% per year. But then it said that in that same time frame, the return for the average investor increased only 3.6%. That's not even half of the annual performance of the S&P. How does that happen?
Well, it's a reality. Delbar does a study very similar to puts that out every year as well, and has very similar results, sadly, where the average investor does typically only 40 to 50% of what the general markets do. Now, there's a myriad of reasons for this. They do not have the education or understanding of how to build a truly diversified portfolio. So investors sometimes go all in on one theory or one position, if you will. And then when that one corrects, and things do, right, then they panic, and they typically make emotional decisions with those dollars, the individual investor, unwinding all the gains they may have had over a long period of time.
So we're talking about the do-it-yourselfer at his kitchen table.
Yes.
Okay.
And so they make bad decisions. They try to time the market. And true wealth, as we just talked about earlier, it's long-term investments. That's how the wealthy invest in those things we were talking about earlier in the show. Well, it's not timing the market. It's time in the market, right? And so you need to stay invested. Charlie Munger, the great Charlie Munger, who passed away last year, one of his favorite quotes I love, and I'm paraphrasing exactly. He goes, "The only thing you don't want to do with compounding is interrupt it, right?
Stay out of the way.
Get out of the way and let your assets compound over time. But individuals try to outsmart themselves, and it costs them dearly. On top of that, that they do not understand some of the fees or expenses with certain types of investments they choose to go in, and it ends up costing them as well. And it's a great article out there. You can Google it and find it, where it kind of gets into all the main factors there. But yeah, it's very true. The average investor does not keep up with the market.
Well, speaking of the late Charlie Munger, here's a question about the Buffett indicator. I've heard you talk about the Buffett indicator. Right now, it says the market is overvalued. What do you think? David, maybe you better first remind us what the Buffett indicator is, and then give us your take.
Yeah, so the Buffett indicator recently cleared, I think, 212% I saw. So the Buffett indicator is basically you take all the public traded stocks, and the one easy way to do this is the Wilshire 5000. It's an index of 5,000 largest publicly traded companies in America. Now, just so you understand, very different world today. When I started, there was over 11,000 publicly traded companies in America. Today, there's about half that. But you just take those and add up the market capitalization of all those companies. What is the value of that? And the Buffett indicator for years was, what is that equated to against our GDP, what we produce as a country? We're about a $27 trillion GDP producing nation. So if the value of the market is more than that, which it is, it's more than twice that, we're over 50 trillion in that means the market is overvalued. Buffett used to say, hey, when the market's undervalued, the Wilshire number would be under the value of the GDP. You'd want to buy stocks for the long term. Now, it is not a timing indicator, just like we talked about. This is not needed to, we don't want to use this for market timing. Yes. So the question was, do I believe the market's overvalued? We measure the market valuation. We do over 23 different ways that you can measure valuation that we look at here. And all of them are saying the market is overvalued, whether you look at price to sales ratios, price to book ratios, PE ratios, what's called PEG ratios. There's a myriad of ways to do this. We have a capital markets assumption model. There's a different ways you can basically value what is the fair value. Now, fair value on the marketplace does not mean what the value is in the marketplace today to make a trade. So you do not want to use market valuation metrics to use to time, but it may tell you, hey, maybe the market's getting a little frothy here, Chip, and we don't want to use it as a timing mechanism. But yes, the market is overvalued, and that just tells us there may be a correction on the horizon, but we can't guarantee that, and nor would we use that as a marking timing on a daily number.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week. Companies on the 2022, 2023, 2024, and 2025 Inc. 5000 lists are ranked according to the percentage of revenue growth from 2019 to 2022, 2020 to 2023, 2021 to 2024, and 2022 to 2025, respectively. The full 2022, 2023, 2024, and 2025 Inc. 5000 lists were published in August of each respective year. Smart Wealth paid Inc. magazine a non-refundable processing fee each year to be considered for inclusion on the Inc. 5000 list.